Hey everyone, and welcome back to another explainer. So as your business grows, your revenue grows, right? And suddenly, taxes start demanding a lot more of your attention. Today, we're exploring a really critical milestone for Canadian sole proprietors and early-stage small business owners. We're going to break down how to know exactly when GST/HST is actually starting to matter for you.
To set the stage, I want to share this quote. Your monthly routine does more than keep expenses organized. It also helps you notice when GST/HST may be starting to matter. GST/HST problems often begin when owners realize too late that the rules have already started to apply. Now, I want to be super clear right off the bat. Approaching this tax threshold is actually a fantastic sign. It means your business is successfully growing. So take a breath. It's not a crisis. It's just a transition. But, the friction really only happens when we don't see it coming.
Right now, we are wrapping up the practice stage of our pathway. This explainer directly follows our material on your monthly money routine, and it serves as the absolute final guide in the practice series for sole proprietors. It's basically the bridge that takes your organized monthly records and turns them into active, forward-looking awareness.
Here's our roadmap for today. We'll be walking through a simple 5-step sequence, knowing the basic threshold, watching revenue before the line, understanding that collected tax is not yours, why you shouldn't rely on memory, and early awareness as a control habit. Then we'll wrap up with the good enough checkpoint.
All right, let's jump right into step 1, knowing the basic threshold.
$30,000. The fundamental rule here is that GST/HST starts to matter when your taxable revenue goes over $30,000. Now, the absolute key word to remember here is revenue. So many new owners mistakenly track profit in their heads, but the CRA only looks at your gross revenue from taxable sales. If you invoice a client, that amount counts towards this line the very moment the invoice is issued or the work is performed, even if you haven't actually collected the cash in your bank account yet.
And honestly, here is where people get tripped up the most. The test isn't just your standard January to December calendar year. It's based on 4 consecutive quarters. This means it is a rolling 12-month period. Your counter doesn't just magically reset to 0 when the new year rings in on January 1st. If your revenue crosses that $30,000 mark in any consecutive 4-quarter window, mandatory registration kicks in.
Moving on to step 2, watch revenue before the line. This is where your monthly financial habits really start paying off. There is a massive difference between approaching the threshold versus actually crossing it. If you wait until your business is clearly above the line to start figuring this stuff out, you're already too late, because crossing it means immediate, mandatory compliance. But if you actively watch your numbers approaching the line, you buy yourself something incredibly valuable: time. Time to understand registration, adjust your pricing, update your invoicing, and figure out your cash handling. If you want to dive a bit deeper into this specific transition, we actually have a related explainer called When the $30,000 GST/HST Threshold Starts to Matter.
Step 3, collected tax is not yours.
This right here is the most vital mindset shift you will make as your business scales. Once you are registered, the GST or HST you add to your invoices and collect from your customers is essentially money you are holding in trust for the government. You are basically just acting as a tax collector. It might physically land in your standard checking account, but treating it like ordinary operating cash is the #1 way small businesses get into a massive cash flow crisis. I highly recommend checking out our other explainer, Why GST/HST Collected is Not Your Money, to fully grasp this concept.
Step 4, don't rely on memory.
Okay, I want you to be totally honest with yourself for a second. Are you currently relying on rough guesses to track your business growth? Are you doing the math in your head, glancing at your bank balance, and just kind of assuming you're still small enough?
The danger here is that tax problems build up super quietly in the background. If you just assume you are still small or probably under the threshold and figure you'll just sort it out later, you are creating a ton of massive, unnecessary risk for yourself. But here is the good news. You absolutely do not need complex, expensive accounting tools to fix this right now. At this stage, a simple, consistent revenue tracking habit is completely enough to keep you safe.
Step 5, early awareness as a control habit.
Listen, the relief here is that the goal is not to turn you into a GST/HST specialist, not at all. The point is simply to notice when your revenue is approaching the threshold so you can act before it becomes urgent. You definitely don't need to memorize CRA manuals. You just need the habit of looking at your revenue tracker once a month. That simple, consistent act of noticing is your control habit. It's what turns a potential tax emergency into a calm, planned business decision.
Finally, let's look at Section 6, the good enough checkpoint.
Let's run through this. GST/HST awareness is working when you know the basic threshold, understand the 4-quarter test, watch revenue before the threshold becomes a surprise, and do not assume all incoming cash is available to spend. If you can confidently check off those 4 boxes, you are doing it right. This is a fantastic measure of your own financial discipline.
And to help you actually implement all of this into your routine, we have a couple of really helpful supporting downloads for you. The GST/HST Threshold Checker is great because it helps you visually monitor your revenue against that registration threshold. And the GST/HST Awareness Worksheet helps you systematically think through whether tax needs to become a part of your daily invoicing, cash handling, and filing routines.
So, to sum it all up, if your revenue is getting close to the threshold, do not wait until year-end. Use the checker, review your numbers, and speak with a qualified tax professional if registration may apply. This officially closes our practice series for sole proprietors, and hopefully it helps you turn your monthly reviews into actual early awareness.
And with that, our practice series is totally complete. As always, please remember this explainer is educational only and does not constitute legal, tax, or accounting advice. But before you go, I want to leave you with one final exciting thought. Now that your financial foundation is firmly built, and you're no longer just guessing, how fast are you ready to grow? Thanks so much for joining me, and I'll catch you in the next explainer.